Good day, guys. Welcome to Forex Walker. The name of my account is Forex Walker. I hope you can see it. You know, because I'm using a laptop, I believe that this word is visible. But if you're gonna be looking at this account, the word Forex Walker from your cell phone, you may not see anything. So here I keep receiving macroeconomic reports that are telling me, macroeconomics keeps telling me that the euro, this is euro Turkish lira. It tells me that the euro will keep moving higher. So for as long as I keep getting these bullish signals, then I believe that this shoulder here, the high that work of schematics that I was telling you guys about, this is the shoulder that we need to take out. Let's say I was telling you about the market moving sideways. I was talking about a compression where the market moves sideways like that. And when it breaks out of the compression here, when it breaks out of the compression, we say, or I say, that the volume is coming in. When the volume is coming in, then it means the central bankers are ready to push the market in the direction of the fundamentals. So that means this stagnant sideways move is over. So that's how I read the market. A lot of people are asking me about a strategy. I just know that when the market is stagnant, it's moving sideways, volume has to come in. And what is important is that you know the actual direction of the market fundamentals. You need to know where the market fundamentals are headed. And the best way for you to understand that is if you can understand the difference between the final economic reports and the preliminary economic reports, and which economic reports are being priced in first and which economic reports are priced in later. So that's the reason why I like talking about time. But I know that if I continue talking about time, one day I will blow my YouTube account, meaning that I will wake up in the morning and discover that my YouTube account is no longer there. So I don't want my YouTube account to disappear. And for that, I will try to stay away from uh, giving you a date, the day that the market will change direction, because well, we here in South Africa, for you to be able to tell someone that tomorrow the market will move up or down, you need to be registered with they call it what, the FS CA or FSBC. I don't remember what it was, but it's a uh, financial services board. So I don't want to tell people that this is where the market is headed, and I'll end up losing my YouTube account because a lot of people are going to be trying to take those trades only to find out that uh, they're looking at my videos like 6 months after the videos were published. So here, this is just the compression that we're talking about, and for us to believe that volume is coming into the markets, we need to take out this shoulder. We need to take out this shoulder here. The reason why it has a long wick like that is something that gives me a belief that this shoulder will be taken out, because the central bankers are very calculating when it comes to how they invest in the market. So taking this shoulder out will help me understand that volume is coming into the markets, and it helps you avoid losing money. And after this shoulder, we expect this shoulder to also be taken out. We call it an expansion. and the market has to come to the order block, this order block here, and drop lower in the direction that we're trying to, the direction that we're trying to trade here. So let me just remove this thing. This is what I call Wyckoff schematics. Those who are asking me what your strategy is this is Wyckoff schematics, the formation of order blocks. Okay, a lot of people don't call it the formation of order blocks. I call it the formation of order blocks. That's how I see it. So this is the calculated version of the market maker patterns. They call them patterns. So the market maker moves, they leave us with something like this. Here I was creating a scenario where the uh, the 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 economic reports are telling you to buy the market. Look at where the buy is. The buy is here, and this is the daily time frame. The buy is here. It takes almost an entire month to get here, but the market fundamentals tell you to buy here. And when you buy here, you get taken out, but the buy is actually down here. So by the time you get to the third touch, that will be manipulated. And when it's manipulated, you also lose money. So that's something that we I had to go through. So this is $20. I created a scenario here. It's just an example of what the market makers are doing. So here they invested $20 here to push the market higher, because macroeconomics says we should buy the market. So they invest $20 here. The market moves up here. They take profit with only $15. This is the profit that they took. So they remain with $5. They allow the market to drop down here by investing $30. They took profit with $15. Remember, when you invest $20 here, when it gets here, it will be something like $120. It will not just be $20, because you're gaining profits in your moves. So let's just say you get up here with a $20, it it becomes $40 or $50. But this is just an example of what I'm saying. So here we're not getting uh, we're not getting we're not gaining anything with the movements of the markets. So let's just say we got $20, we take profit with $15, and we remain with $5 in the market, and we collect the stop losses here. The central bankers, they invest $30 after taking profit. They push the market lower, and when the market comes down here, when they take profit with uh, $25. The reason why I say $25 is because they are down by minus $5 from here when they took 15. So because of that, even if they try to take a profit with all of $30, they won't be able, because they're down by minus $5. So they took profit by minus $25. They're still in by negative $5. And the market makers, they push the market higher with $40, and when they get up here, they're able to take profit with $40 for the first time. Now the question is, how much do they have? So what they have is this minus $5. It moved into profits. Remember, this level here is where this $5 comes back into profit. Here we're in the negatives, but once it comes up here, this $5 become positive. So because of that, we're able to take profit with $40. uh, Remember, when we take profit with $40, we need to close this position and remain with a $5 that comes from this level of the market. So this one, we take profit with the $5. We remain in we leave $5 from this level of this entry level. So when we push the market lower, we might push it with $50 or whatever. And when we come down here, we're able to be down from here, not here. We're able to be down from this entry level because this one was liquidated by taking profit up here. We're able to be down by minus $10 from this level, and we take profit from whatever we invested here. I did not draft it. And when the market moves back into profits above this entry level, we're able to take profit however higher the market will go. But what is important here is to understand that when the central bankers, when they buy the market, they also sell it. They put in more buys than sells, and when the market comes down here, they put in more sells than buys, but they always have a negative in their profits. There's always a negative. Some of their when they take profit, some of their positions are still in the negatives. That's how the central bankers trade. But remember, the central bankers, they don't make money by moving the market. This huge move here, it does not make money for them. These people only make money by collecting stop losses. That's the dirty way that they use for trading. So here they made money because they collected the stop losses for the guys who went long here. And when they came up here, the guys who were trading, who were going short on the order block that they believe is an order block here, when they were selling here with their sell stops or sell limits, they took them out here, they collected their stop losses, and the central bankers made enough money. So for the guys who went long here and they did not take profit here or a trailing stop, who did not have a trailing stop, when the market comes down here, it collects their stop losses down here. So these guys are taken out. So after the bosses got paid here, here, and here, that's where I believe I always tell you guys about the first touch, the second touch, and the third touch that manipulates the market. So it's just something that happens all the time. The third touch always manipulates the market. Let me try to draft it. So this is the first touch, the second touch, the third touch has to manipulate the market. That's how I believe in the trades that I take. Most of the time when I say I wish that the market could just manipulate this level, for me to believe in that long move. So the reason why I want the market to manipulate the level is because just to uh, just to be content with the fact that my bosses got paid, the central bankers made enough money. So all of these things where they stop traders out and they stop traders out is just my bosses getting paid. So that's just the system that I use. I need to wait for my bosses to get paid first so that I can get paid. That's how I look into the markets. At the end of the day, the central bankers, they invest in they are very calculating when it comes to their positions. They don't take losses. They just don't like taking losses. So that's why they have certain levels where they don't want the market to drop below or above. Even when it drops below, it has to give them a fraction of a negative. It has to give them the lowest negatives possible. They cannot go down with big money when they invested $20 and they end up going down by $40 by investing 20. They cannot allow that to happen. They want to go down with small margins so that when the market comes back, they can regain those losses. Though the central bankers don't take losses. That's just how they trade. So I call them central bankers, but those are institutions. They are the banks and the world banks. So goodbye, guys. I will see you guys on the next episode.